What if I told you there's a way to invest in the entire AI revolution without betting on a single stock? While everyone's arguing over whether NVIDIA or AMD will win the AI race, smart investors are buying the whole racetrack. Today I'm breaking down the best AI ETFs for 2026, how they work, and which ones deserve your money. Let's get into it. Here's the problem with picking individual AI stocks. The AI market is worth over $200 billion today and projected to hit $2 trillion by 2030. But here's the catch. Nobody knows which companies will dominate. 5 years ago, everyone thought Intel would lead the AI chip race. Today, NVIDIA controls 80% of the AI training market. The winners change fast. And if you pick the wrong stock, you could lose everything while the sector doubles. That's where AI ETFs come in. Instead of picking one horse, you bet on the entire race. An ETF is an exchange-traded fund. Think of it like a basket of stocks that trades as a single share. When you buy one share of an AI ETF, you're buying a piece of every company in that fund. Some AI ETFs hold 50 to 100 companies. Others focus on 20 to 30 pure-play AI stocks. The key advantage is diversification. If one company fails, your portfolio survives. And ETFs have lower fees than mutual funds, usually 0.5 to 0.75% per year. That's a small price to pay for instant diversification across the entire AI sector. First up, the Chat ETF from Roundhill. This is the most popular pure-play AI ETF with over $2 billion in assets. It holds 25 to 30 companies focused specifically on generative AI. Top holdings include NVIDIA, Microsoft, Alphabet, Meta, and Amazon. The expense ratio is 0.75%. What makes Chat unique is its narrow focus. It only includes companies that are directly building or deploying generative AI. Not every tech company makes the cut. If you want targeted exposure to the AI boom, Chat is the starting point. Next, the AIQ ETF from Global X. This one is broader with over 80 holdings. It includes not just pure AI companies, but also firms using AI across their business. Think healthcare companies using AI for drug discovery, financial firms using AI for trading, manufacturers using AI for automation. The expense ratio is 0.68%, slightly cheaper than Chat. The broader approach means more diversification, but less upside if pure AI plays explode. It's a good balance between risk and reward. Now let's talk about BOTZ, the Robotics and AI ETF. This is interesting because it covers the physical side of AI. We're talking humanoid robots, industrial automation, autonomous vehicles. Top holdings include Intuitive Surgical, ABB, Fanuc, and Keyence. The thesis here is that AI isn't just software. It's robots building factories, performing surgery, and driving trucks. BOTZ has about $1.5 billion in assets and an expense ratio of 0.68%. If you believe the future is physical AI, this is your play. Let's not forget the foundation of AI, semiconductors. The SMH ETF tracks the 25 largest semiconductor companies. This includes NVIDIA, Taiwan Semiconductor, Broadcom, AMD, and Qualcomm. Semiconductors are the picks and shovels of the AI gold rush. Every AI model needs chips to train and run. SMH has been around longer than pure AI ETFs and has proven track record. The expense ratio is just 0.35%, making it the cheapest option. If you want AI exposure with lower fees and proven performance, SMH is worth considering. And finally, the newest player, KOD from Crane Shares. This just launched as the first US-listed humanoid robotics ETF. It covers the full supply chain, the brain, the body, and the builders of humanoid robots. What makes KOD unique is that it includes private companies like Anthropic and SpaceX through a special structure. Up to 10% of the fund can be in private assets. That's something most ETFs can't offer. The humanoid robotics market is expected to hit $38 billion by 2035. This is a high-risk, high-reward play on the next frontier of AI. So which one should you buy? Here's the breakdown. If you want pure generative AI exposure, go with Chat. If you want broader AI adoption across industries, AIQ is your pick. For physical AI and robotics, BOTZ covers that space. For the cheapest option with proven performance, SMH gives you semiconductor exposure. And for high risk, high reward on humanoid robots, KOD is the new frontier. You can mix and match. A common strategy is course satellite. Put 60% in a broad ETF like AIQ, then 20% each in two focused plays like Chat and BOTZ. Now let's talk risks. AI ETFs are not safe bets. The sector is volatile. In 2026 alone, we've seen AI stocks crash 25% in a single week. Memcan concerns, overbuilding fears, and valuation worries are real. ETFs reduce single stock risk, but they don't eliminate sector risk. If AI hype dies down, all AI ETFs will suffer. Also, expense ratios add up. At 0.75%, you're paying $75 per year for every $10,000 invested. Over 20 years, that's significant. And past performance doesn't guarantee future results. The AI revolution is real, but timing the market is impossible. Here's how I'm positioning. I'm using a 3-layer approach. Layer 1 is my core holding in SMH for cheap semiconductor exposure. Layer 2 is Chat for targeted generative AI bets. Layer 3 is a small position in KOD for asymmetric upside on humanoid robotics. The key is position sizing. I'm keeping AI ETFs to 15 to 20% of my total portfolio. That gives me exposure to the upside while protecting me if the sector corrects. And I'm dollar cost averaging monthly, not lump sum investing. That way I buy more when prices dip and less when they spike. Discipline beats timing. Which AI ETF are you buying? Are you going broad with AIQ or focused with Chat? Or are you betting on robotics with BOTZ or KOD? Drop a comment below. And if you want to see how Kronos predicts these AI ETFs will perform over the next 30 days, hit that subscribe button. We're running predictions on every single one of these funds. The data doesn't lie, but the market moves fast. So stay informed, stay disciplined, and as always, this is not financial advice. Do your own research. See you in the next one. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor before making investment decisions.